Well, welcome back. Of course, we have just entered the second quarter of the year, and it's time for us to really reflect on what happened in the first quarter and find out whether this will be influencing investor decisions on where to place their money into the second quarter. Joining me for that discussion right now is Wessel Joubert, who is an investment associate at Cannon Asset Managers. Wessel, thanks so much for your time. As we were briefly chatting, you and I, the platinum guys, by far the biggest gainers because of the dynamics in the palladium market.
Exactly.
Just looking just below that, if we go past the top 5 or 6, which the platinum guys actually occupy, an interesting cat or play, Clover. And I imagine that's got to do with more of the takeover rather than the dynamics in the dairy business.
That's exactly it. So currently I think Clover is trading at about 1% or 2% below the offer price. So that's 100%. I think it's up 30% for the first quarter roughly, and that has to do with a buyout offer.
And then afterwards, quite a lot of our market is tilted to, outside, and therefore gets quite a lot of support given what the currency is doing. I see that quite a lot of the rand hedge guys, your British American Tobacco and Anheuser-Busch, also are doing quite well because of the rand.
Yeah. So there are two dynamics to that. I think the first one is a lot of the local portfolio managers want to get offshore exposure. So utilizing your 25 to 30% that you are allowed to take offshore, and then they start buying with the other remaining 75% of their allocation. They buy the rand hedges with effectively a South African stock, but with 80 or 90% of earnings actually coming offshore. So a lot of the guys had quite negative sentiment around SA Inc. The local economy is struggling. There's no doubt about that when you look at all the GDP growth and unemployment numbers. And then the second part to it is I think a lot of index trackers hold a lot of those big heavyweights, I can call them, the rand hedges. And with guys moving towards a low fee index tracking environment as well, it's just a little bit of a gain there. In the share prices.
And with the Naspers and its recent announcement to unbundle further, saying one of those things were, restrictions of the local investors to hold more of Naspers stock, that counter up some 18% or so in the first 3 months of this year, which is really good, compared to the performance that it had last year, and all tied to regulations in China, mostly.
So that's one of the other dynamics as well, is a lot of these guys actually came off quite a low base. I think Naspers started out 2017 on around about 4,000, went down to about 3,000, and it's back at 3,300 or so. So, and it's the same thing for the platinum producers as well. They were hanging around at lows before they got this gain. So on Naspers specifically, it's effectively just the biggest asset in there is Tencent now, which is effectively just offshore. So them taking the listing on Amsterdam and then a secondary listing in SA is to help them get that discount closer to the NAV.
Yeah, to also help you guys have a little bit more of them. But bringing it back to the sour sentiment on South African companies, and I'm actually looking at them because the bulk of them are at the laggard side of the JSE, and let's just perhaps put the spotlight on the retailers and the banks first. Why such soured sentiment for these guys? Is it all because of the economy, or are other factors here at play?
So a lot of them do have stock-specific factors impacting them. You can see it in Woolies, EOH. What was the other one? Tonguard as well. A lot of them, so those do have stock-specific things, but in general the SA Inc. shares are struggling. You can see that they're struggling with keeping costs below inflation increases. We're facing electricity increases and so on above inflation, which is an input cost for a lot of these guys. And on the second part, they're struggling to grow revenue, so top line. And that is a factor of the weak SA economy. Jobs isn't growing, fixed capital formation is kind of stagnant, which precedes employment growth. So it's a pretty gloom picture. And then on the other side, you've got a lot of competition and new age companies coming in. On the banking side, you've got a bunch of new competitors entering the market. And even though they probably won't take a massive share from the market, they might just take the little bit of growth that was supposed to go to the current banks they will take and slowly eat away.
Yeah, and also what's interesting is also the laggards of the South African companies are those who have got quite a number of their operations tied to the UK. I mean, I'm looking at the performance of Brait in the first quarter. I'm looking at the performance of even Truworths in the first quarter. So that clearly reflects you guys are quite nervous about how Brexit will unfold and essentially how it will affect your money.
Yeah, I think there's a lot of uncertainty about Brexit. I think it is becoming clearer as time goes on, but investors are scared. I mean, you don't want to wake up one day and hear that, okay, well, due to a slight change in like the dynamics, you now have to pay an extra tax or extra import duties, and all of a sudden the business that side becomes uneconomical. And so I think for lack of being able to quantify the risk associated with it, a lot of guys are holding back with just purchasing these shares.
Wessel, thanks so much for your time. We will leave it there. Of course, we were having a conversation about the gainers and the losers on the JSE so far this year with Wessel Joubert, who is the investment associate at Cannon Asset Managers. Now, one of the